Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today we're diving into Lululemon Athletica Inc., ticker symbol LULU. And if you've been watching the markets this year, you definitely know the severity of the situation here. LULU stock has been absolutely hammered.
Hammered is putting it mildly.
Yeah, it's plummeted over 50% just this year alone. That kind of decline, well, it marks its worst performance since 2008, the year of the global financial crisis.
Which is an incredibly stark comparison, isn't it? For a brand that honestly seemed almost immune to retail gravity for so long.
Exactly. It felt untouchable.
And that kind of severe, sustained drop, it really demands that we, and you, the listener, look past just the headline numbers. We have to ask a really fundamental question here.
Which is
this just a temporary operational blip? Maybe a product line hiccup they can fix in a quarter or two? Or are we actually witnessing something deeper, like a fundamental erosion of the competitive edge for a premium brand that has commanded, let's face it, market-leading prices for decades?
Right. The stakes feel pretty high, existential even.
You really are.
And the sources we've looked at suggest Lululemon isn't just dealing with one single problem. It feels more like a perfect storm scenario.
That's a good way to put it, yeah. You've got these massive external financial shocks colliding head-on with what management itself is calling internal self-inflicted wounds, mostly around product execution and, well, strategy.
Okay, so that's the core tension we need to unpack today.
Precisely. So our deep dive thesis today, let's lay it out clearly. Lululemon's undisputed brand moat, that incredible customer loyalty, the premium status it's currently being severely discounted by two sort of seismic forces hitting at once.
Okay, what are they?
First, you've got this crippling collapse in its main market, the Americas. We saw comparable sales slide there by -4% in Q2. Just brutal.
4%, wow.
Yeah. And second, this sudden, just crippling external tariff shock, it popped up unexpectedly and is estimated to cut the company's gross profit by roughly $240 million this year alone.
Okay, so a double hit.
A major double hit. And this whole scenario, it necessitates an immediate, radical, company-wide innovation race. They basically have to sprint just to justify that high-quality status and, maybe even more importantly, that massive price premium we all associate with their gear. Hashtag ILO.
Yeah.
The crippling tariff shock and profit cut.
Okay, let's start with the hard financial reality that really signaled this crisis. If we look at the Q2 fiscal 2025 results, overall net revenue was up about 7% to $2.5 billion.
Right, and 7% growth, it's not like the business is failing outright.
No.
But for Lululemon, a company built on expectations of like 20% growth year after year, 7% feels less like growth and more like the engine is just sputtering.
Yeah, sputtering out of gas. It's a good analogy.
And the really critical number, the one that shows customer engagement and brand health overall comparable sales growth, that combines existing stores and online.
Right.
It grew just 1%. 1%. When you're supposed to be this high-growth premium lifestyle brand, 1% comp growth is. Well, it's basically stagnation. And that market reaction plus this external shock we mentioned, that's what really forced their hand on the guidance.
Well, the guidance. And this is where the market truly panicked, right? Lululemon's profitability, which is usually an industry benchmark, it just took a massive hit. They had to severely slash their full-year earnings per share, the EPS guidance.
That slash was a real gut punch. I mean, they were previously guiding for, $14.58 to $14.78 per share. That new guidance got chopped dramatically, down to $12.77 to $12.97.
So you're looking at an almost $2 reduction in expected profit per share.
Almost $2. This isn't just minor volatility we're talking about. This signals that the financial damage is structural, it's immediate, and it's extremely costly to their whole operating model.
Right.
It's actually why a lot of analysts are still pretty skeptical. They fear this lowered guidance might still not fully capture just how difficult this turnaround is going to be.
Okay, but the immediate trigger for this severity, this sudden massive input cost, that was external, you said, the removal of the de minimis exemption.
Yes, exactly. It sounds like complex trade policy jargon, I know.
It does a bit. Yeah.
But it's absolutely crucial to understanding the financial pain here. It was the single most significant external hit Lululemon faced recently.
Okay, so break it down for us. What is de minimis?
Right. So simply put, de minimis was this, maybe somewhat obscure, U.S. customs rule. It basically allowed any imported goods valued under $800 to enter the U.S. completely duty-free. Zero tariffs, zero taxes.
Okay, under $800 duty-free. Got it.
And Lululemon, being a pretty sophisticated global retailer, they had essentially built their entire last-mile logistics model to strategically exploit this loophole. And honestly, they were doing it brilliantly until it stopped.
How exactly were they exploiting it, and just how reliant were they on this?
Well, they optimized their whole logistics network to take maximum advantage of that $800 duty-free threshold. Sources estimate they were shipping a really staggering amount, maybe 60% to 70% of all their U.S. online orders, package by individual package,
Wow.
from warehouses located just across the border in Canada.
Okay.
So under de minimis, those packages, often just containing 1 or 2 items, safely under the $800 limit, they just flew into the U.S., landed on the consumer's doorstep, and Lululemon paid 0 tariffs. It was fast, it was efficient, and critically, it was duty-free.
But then suddenly that whole political and logistical landscape just changed overnight. This was driven by pressure from U.S. lawmakers, right?
Yeah.
Targeting this exemption.
Exactly right. Lawmakers started viewing it as an unfair loophole, mainly benefiting, fast fashion imports, often goods made overseas without maybe the proper oversight, so the pressure mounted.
And Lululemon got caught in the crossfire.
Pretty much. When that exemption was removed, or at least neutralized for Lululemon's specific Canada to U.S. shipping strategy, those exact same shipments, they went from incurring 0 tariffs to incurring full U.S. customs duties. Just like that.
Ouch.
Management has openly called it a paradigm change. And that's not an exaggeration, because it's not just about paying the new tax. It forces a complete, probably multi-year logistical overhaul.
How so?
Well, they have to dramatically scale back using that rapid air freight from Canada for direct orders. Instead, they have to shift to slower but tariff-inclusive bulk ocean freight. And at the same time, they need to massively expand their U.S.-based distribution center footprint just to handle fulfillment domestically.
So this is a huge operational nightmare, not just an accounting line item. And the price tag for this shock must be staggering.
The cost is enormous, and we can quantify it. This single policy shift is estimated to cut Lululemon's gross profit by roughly $240 million just this fiscal year.
$240 million.
And some analysts looking further out suggest the sort of knock-on effect on operating margins could reach maybe $320 million by fiscal year 2026. This is the definition of external, crippling financial pain.
And we see that pain showing up immediately in the margins, right? That's the key profitability indicator our listeners watch. Gross margin profitability of the product itself before operating costs that's expected to drop by 300 basis points compared to last year.
300 basis points, 3 full percentage points wiped directly off their industry-leading gross margin.
That's huge for them.
It is. For our informed audience, the significance here is Lululemon has always been able to price their stuff at a massive premium, partly because their gross margins hovered near 60%. That shielded their cost structure, allowed for rapid investment. A 300 basis point drop fundamentally changes their competitive position relative to premium peers like Nike, or even those emerging threats like Alo and Vori.
And what makes it even more shocking, didn't they forecast a much smaller hit just recently?
Exactly. That's what's so jarring. Their previous forecast made only months earlier was for maybe a 110 basis point hit. So the reality is almost triple what they expected just a short while ago. It really shows just how severe and sudden the full weight of this logistical collapse actually was. #2, domestic crisis, innovation fix, and growth engine.
Okay, so that's the crushing tariff shock from the outside. But now we need to turn to the market that really, controls their destiny, the Americas. That's about 75% of their total revenue, right?
Right, 75%. And this is where those self-inflicted wounds really start to show.
So what happened domestically?
Well, the domestic market is the real epicenter of this crisis. In Q2, comparable sales in the Americas region, they didn't just slow down, they actually decreased 4% year over year.
Down 4%.
Yeah, and even if you adjust for currency fluctuations, that's still a 3% decline.
And in the U.S. specifically?
If you isolate just the U.S. net revenue, their single biggest market, it was completely flat. 0 growth.
0 growth in the U.S.
Yeah. A 4% comp decline in your premium home market, that is a severe alarm bell. It suggests the average customer just isn't increasing their basket size or coming back as often.
And management couldn't really blame tariffs for this domestic softness, could they?
No, not directly. CEO Calvin McDonald was actually pretty transparent about it. He squarely blamed the performance on product execution.
Product execution.
Yeah.
Okay, but what specifically was wrong with the product? I mean, they still sell the Align pants. Everyone loves those, right?
They do, and that's the really crucial nuance here. McDonald specified that the core performance gear, The stuff people actually use for yoga, running, serious training that actually continued to see growth.
Okay. So where was the failure?
The problem was a structural failure in the casual wear category. He argued the company became, and this is his quote, too predictable within our casual offerings.
Predictable.
Yeah. And this is a huge segment for them. It covers things like loungewear, hoodies, the scuba jackets, joggers. It accounts for roughly 40% of their total sales.
40%.
Right.
So if I'm a customer and I already own, let's say, a perfect, really durable black scuba hoodie, and that thing lasts for years.
Exactly.
And the company keeps releasing versions that look, well, basically the same, why would I buy another one? Especially when, inflation is tightening everyone's budget.
That's precisely the issue. They excelled maybe too well at creating these durable, high-quality, high-margin basics. But in that casual space, they just failed to inject enough excitement, not enough new colorways, new textures, new silhouettes. Basically, not enough reasons to prompt a repeat purchase cycle.
So the inventory was just full of the same old stuff.
Pretty much. Dominated by core items, not enough trend-setting newness. The diagnosis seems clear. They're kind of victims of their own success and durability, combined with a failure in creative execution on the casual side.
Okay, so the immediate solution they're proposing is this innovation race. What does that actually look like on the ground?
It sounds like a pretty rapid cultural and inventory shift. Management has set a very clear quantitative goal here.
Which?
They need to accelerate the introduction of new styles so that newness accounts for up to 35% of the total product assortment by spring 2026.
35% new styles. That sounds like a lot.
It is. It means moving away from just re-releasing the same, say, 10 items in different colors. It forces the design teams to rapidly inject real novelty across all those casual categories. That 35% goal is definitely an aggressive internal mandate.
And they're pairing this internal inventory push with some higher profile external marketing moves too, right? Trying to broaden the audience?
Yeah, trying to shed that perception of being purely a yoga brand, or maybe just for women.
Like the NFL deal?
The NFL branding deal is a major shift, yes. They recently announced a new line of NFL-branded apparel through Fanatics. This is clearly an attempt to raise their profile beyond that core female demographic and capture, the huge male fan base of pro football. It positions Lululemon not just as technical gear, but as premium, logo-driven lifestyle sportswear.
So a direct challenge to brands like Nike and Adidas in that high-end sports leisure space.
Absolutely, a very direct challenge.
Okay, moving back to the financial pressure for a second. We know they're fighting that tariff shock. What immediate steps or mitigation efforts are they taking to absorb that $240 million hit?
They seem to be pulling three main levers pretty hard right now.
Okay, lever one.
First, they are implementing strategic price increases on certain items, particularly the new styles. They're carefully trying to pass some of that tariff cost onto the consumer without, causing sticker shock.
Tricky balance. Lever two.
Second, a significant tech investment. They just hired a chief AI and technology officer.
Interesting. Is that just for show?
Doesn't seem like it. The explicit goal is to use AI to drastically speed up demand prediction and product development. The idea is to get innovative, high-demand products to market much faster, which should reduce waste and increase inventory velocity.
Okay, makes sense. And the third lever must be tackling the logistics head-on, avoiding future tariff issues.
Absolutely. That's the big one long-term. They are aggressively diversifying their supply chain footprint, moving production out of high-cost or maybe high-tariff areas and into lower-cost hubs. They specifically mention Mexico as a growing manufacturing destination.
So a long-term strategic shift.
Definitely. It's designed to insulate the company from similar geopolitical trade disruptions down the road. It shows they are, at least, learning from this de minimis mistake. And these mitigation efforts, all three, are expected to have the biggest positive impact in the second half of this fiscal year.
Okay, so that paints the picture of the troubled domestic market and the extensive fix they're attempting.
Yeah.
But there's a critical silver lining here, isn't there? The cushion that's buying them time.
Yes, the international lifeline. That's absolutely crucial right now.
How's that looking?
International expansion is really the saving grace. It's the only true growth engine Lululemon seems to possess at the moment. While the Americas declined, international net revenue surged 22%.
22%.
Yeah, or 20% if you adjust for currency.
Yeah.
This is that textbook aspirational growth everyone expects from them, especially when you look at the Asia-Pacific region.
And China mainland specifically is just Booming for them.
It's proving to be an absolute powerhouse. The numbers are phenomenal. China mainland revenue was up a solid 25%. And management is projecting that impressive 25% to 30% growth rate will likely hold for the full year. It really seems like the Lululemon brand still has that highly sought-after, aspirational, premium, exclusive feel in the Asian market, something they're kind of struggling to maintain in their saturated home market right now.
And this international success must be directly fueling their bigger future strategy.
It is. This is what underpins their whole Power of 3x2 plan. That's the strategy aimed at quadrupling international revenue by 2026.
Quadrupling.
Ambitious.
Very ambitious. And they're not slowing down store growth overall. They're just redirecting it internationally. They plan to open 40 to 45 net new stores this year, overwhelmingly focused outside North America.
Where specifically? We're seeing aggressive expansion in China, obviously. They're taking over franchise stores in Mexico to run them directly, and they made that high-profile debut in Italy with a store in Milan. This massive capital commitment, though, really relies heavily on the continued success of these global markets.
Okay, so given all these moving parts, the tariff shocks, the logistics overhaul needed, this innovation race, what's management's realistic timeline? When do they expect to achieve stabilization and get back to that high growth the market demands?
Well, CEO McDonald has been, I think, refreshingly realistic on this point. He stated that achieving stabilization and a significant sales growth rebound in the U.S. market, combined with stabilizing margins after the tariff hit, well, that whole process is expected to take until sometime in 2026.
Sometime in 2026.
Yeah.
Oh.
They're essentially asking the market to absorb the pain and just show patience for another, year and a half while they execute this turnaround plan.
That is a long time in the retail world.
It's an eternity. #3. Founders' critique and reputational risks. And that lengthy timeline is precisely why the voice of the founder, Chip Wilson, is carrying so much weight right now. He's still a significant shareholder, remember?
Right.
And he's launching this really sharp, incredibly influential critique. He's basically arguing the company is fundamentally losing its soul.
Losing its soul, that's pretty powerful language. It suggests maybe a cultural failure, not just a temporary financial blip.
Exactly. He claims the current leadership has replaced that founding ethos, creative risk-taking, singular product focus with just corporate process bureaucracy.
Process bureaucracy, okay.
This is really the core of his argument.
Yeah.
That Lululemon has become risk-averse. They prefer predictable, maybe committee-approved product lines over the kind of breakthrough, innovative styles that actually built the brand in the first place. And this cultural shift, he argues, leads directly to this term he coined, G-apization.
G-apization. Okay, can you break that down? What does he mean comparing Lululemon to the Gap?
It's a really potent warning about brand life cycle, isn't it? Wilson basically fears Lululemon is becoming bland, conservative, just settling into the boring middle center of the athleisure category.
Like the Gap did.
Exactly. The Gap historically went from being this revolutionary brand to one defined by safe, kind of unexciting basics. It lost its edge and ultimately had to rely on constant promotions just to move product. Wilson is terrified. Lululemon is heading down that same path, losing the disruptive status that justifies, paying $128 for a jacket.
And Wilson points to specific, expensive examples of what he sees as management's lack of focus, right? Like the Mirror acquisition.
Oh, yes, the Mirror acquisition. That $500 million purchase of the interactive fitness company Mirror, which they then branded Lululemon Studio.
$500 million.
Wilson points directly to that $500 million spend as just squandered capital, a massive distraction that pulled focus and resources away from core product innovation. And the irony is particularly stark now, given that Lululemon ended up discontinuing the main hardware business for Mirror anyway.
Yeah, that didn't look great.
No. And it really bolsters his argument that leadership is maybe playing it safe with the closing, but being reckless with shareholder cash on these peripheral, tech-driven vanity projects that ultimately failed.
It's fascinating, too. Wilson argues the company is caught in something he calls a durability paradox, which sounds like a problem every consumer wishes companies had, but it's a nightmare for retail sales velocity.
It really is the ultimate retail paradox. Wilson observed that the company's commitment to quality, which customers love, means the products are fundamentally too durable.
Right.
So while you, the customer, love that your Align leggings last for 5 years, it's terrible for repeat sales velocity, especially in that casual category where innovation has stalled. Why buy a new $128 jacket when the one you bought 3 years ago still looks basically brand new?
Good point.
This high durability, combined with that failure to inject novelty, it just creates a wall against the constant influx of revenue you need from repeat customers in retail.
And while they're having this internal debate about durability and predictability, the brand's protective moat outside is springing some serious leaks.
Oh, the moat is definitely under attack. Internally, you've got intense competition from these agile, faction-forward brands like Alo Yoga and Vori. They're rapidly stealing market share, especially among younger consumers.
Right.
But the most direct, maybe most aggressive threat to their premium pricing power comes from this wave of dupes, knockoffs.
And this actually played out in a really high-profile legal battle recently with a massive retailer, Costco.
That's right, the lawsuit against Costco, a company known for selling high-quality generic versions of branded goods at low prices. Lululemon filed suit, basically claiming Costco was selling unauthorized and unlicensed knockoffs.
Of which product specifically?
Specifically, a near-identical version of their iconic $128 scuba full zip jacket, sold under Costco's own Kirkland signature label for about $20.
$20 versus $128. That's an 80% price difference for something that looks almost identical. What was Lululemon's main legal argument?
Well, the suit wasn't just about copyright infringement. It focused heavily on things like industrial design and trade dress, basically. The overall look, feel, and functionality that consumers instantly associate with Lululemon's specific product.
Okay.
Their argument is, if the market is suddenly flooded with $20 alternatives that look and often feel remarkably similar, it severely risks permanently diluting Lululemon's premium brand image.
Because the customer starts asking.
Exactly. The customer asks, well, if the Costco dupe satisfies my need for $20, why exactly am I paying $128 for the branded version? That question is an existential threat to their entire high-margin business model.
And this whole combination, declining domestic sales, the need to flood the market with new styles, it must be creating enormous pressure on their balance sheet too, specifically inventory.
We see that pressure very clearly quantified in the inventory numbers.
Yeah.
Total inventory jumped a massive 21% year over year. It reached $1.7 billion.
$1.7 billion in inventory.
Yeah. And this substantial inventory increase is dangerously mismatched with flat U.S. sales growth. That immediately creates the risk of needing markdowns to clear it.
Are they expecting markdowns?
Management is anticipating a slight increase in markdowns, maybe about a 10 to 20 basis point increase compared to last year. Now, that sounds small, but any increase in discounting for a premium brand like Lululemon signals weakness. And it further fuels those analyst worries that they might be structurally weakening Lululemon's premium position by essentially training the customer to wait for a sale. Hashtag 5E. Bull case, fundamentals, and valuation. Okay, so despite all that, the deep financial cuts, the founders' really scathing critique, the logistical nightmare with tariffs, the stock's 50% plunge, hasn't scared everyone away. It's actually generated significant contrarian, bullish investment sentiment.
Right, the classic falling knife scenario, where some smart money starts betting the rebound will be just as violent as the fall.
Exactly. You start to see people looking for the bottom.
And that sentiment seems to be attracting some pretty famous contrarian investors. We saw Michael Burry's Scion Asset Management, famously documented in The Big Short, actually took a new LULU call option position in Q2.
That move is a classic contrarian signal, isn't it? When a deep value investor like Burry steps in, he's essentially making an argument. He's arguing that the market has fundamentally mispriced the risk here.
That the bad news is already baked in.
Pretty much. That all the bad news is already reflected in the stock price, and that the underlying assets of the company are actually worth substantially more than the current valuation implies. The entire bull case really hinges on the stock's current trading multiples, which look historically cheap after this massive sell-off.
Okay, let's talk specifics on that valuation then. What are we actually looking at when we compare LULU to its retail peers right now?
We're talking about incredibly low trading multiples for what is still fundamentally a quality growth company. The stock is currently trading at a forward price to earnings, or PE, multiple of just 13 to 16 times earnings.
13 to 16x.
And an enterprise value to EBITDA, or EBITDA multiple, around 8 times.
8 times EBITDA. And how do those multiples stack up against, say, a major competitor like Nike?
Well, the difference is dramatic. Nike typically trades at a PE multiple of somewhere between 35 and 44 times earnings.
Wow, okay. Huge difference.
Huge. And the core argument from the bulls is basically this. Lululemon's historical financial structure, its margin performance, has often been superior to Nike's. Yet right now, the market is pricing LULU as if it were some struggling regional department store about to go under.
So the valuation implies the market expects almost no growth.
Exactly. Near zero growth and continued margin contraction. Bulls argue that's wildly overpunishing the company for the current issues. They see a stock that is just deeply undervalued right now.
And supporting this turnaround effort, underneath it all, is Lululemon's still exceptional underlying financial structure, right?
Absolutely. The fundamentals are rock solid. And this is what gives management the luxury of time, despite the founders' loud concerns.
What do those fundamentals look like?
Well, they hold between $1.3 billion and $2 billion in cash on the balance sheet, with very low to basically no debt. They continue to generate robust free cash flow. And even with that big tariff hit, they still maintain industry-leading gross margins. They're still aiming for figures near 57%.
Right.
These are not the financials of a company struggling for solvency. They're the financials of a fundamentally strong company dealing with a major but potentially temporary operational speed bump.
And management seems to be signaling confidence, too, putting its money where its mouth is.
Their actions definitely speak louder than their earnings call commentary sometimes. Management aggressively repurchased 1.13 million shares of stock just in Q2 alone.
1.13 million shares.
That is a very concrete signal. It's a vote of confidence from the executive suite that they believe the current stock price is dramatically lower than what they see as its intrinsic long-term value.
And beyond just the financial metrics, there's still that intangible asset, the brand moat. That loyalty isn't just erased overnight, is it?
No, and that brand stickiness is really the entire foundation of the bull case. Lululemon has an incredibly loyal, high lifetime value customer base. They have industry-leading repeat purchase rates, and maybe crucially, thinking about future consumers.
Yeah.
Lululemon was recently ranked the #1 apparel brand among female teens in a major Piper Sandler survey.
Top brand for female teens.
Okay. That means, despite maybe some saturation in the adult market, they still maintain that aspirational status with the next generation of high-spending consumers.
Yeah.
That demographic loyalty is a massive asset that probably prevents the brand from completely collapsing under this pressure.
Okay, but to keep a balanced view here,
Yeah.
even these attractive low valuation metrics, they come with a critical warning from the bears, right?
Absolutely. The bear cautionary note is that these cheap-looking multiples could be a classic value trap.
A value trap, meaning
Meaning the stock looks cheap for a reason, and it might stay cheap or even get cheaper. The fear is that Lululemon's historical peak operating margins, which often exceeded 20%, are simply unsustainable going forward.
why unsustainable?
Due to market saturation, intensified competition from both premium brands and those dupes we talked about, and maybe the irreversible structural cost changes brought on by the tariff shock. Some analysts are actually so worried about the high fixed costs associated with their aggressive global store expansion,
Yep.
especially the cost of new store leases, that they're suggesting management should maybe actually halt store growth entirely in 2026, just conserve cash and avoid what they term rent delever.
Rent delever,
Yeah.
meaning the cost of the stores outpaces the sales growth from them.
Exactly, where the cost of maintaining that physical footprint starts to drag down overall profitability because sales aren't growing fast enough to cover it. That's the value trap fear.
Yeah.
Hashtag text tag synthesis, verdict, and conclusion. So when we synthesize all this, we really have two highly compelling but almost contradictory narratives fighting it out here.
Right.
On one side, you have Lululemon fighting these internal self-inflicted wounds, primarily that failure of predictable product execution in the casual category, which drove U.S. growth down to zero.
Okay, the internal battle.
And then on the other side, they're simultaneously fighting these massive kind of unavoidable external crippling shocks, mainly that sudden $240 million gross profit hit from the de minimis tariff rule change. So the company is having to radically innovate its products while also navigating a complete logistical revolution at the same time.
A fight on two fronts.
Absolutely.
And the verdict on how long this fight is expected to last?
Yeah.
That comes directly from management, doesn't it?
It does. They've set the expectation. Stabilization and a significant sales growth rebound are expected to take until sometime in 2026.
Sometime in 2026.
Which means the market, and you, the investor, you have to believe in their ability to execute a really complex turnaround over quite an extended period.
And that execution window, that breathing room, It's only really possible because of one thing.
It's only possible because of that international lifeline we discussed. That sustained roughly 25% growth in China that provides the absolutely essential financial cushion right now. It buys management the necessary time and, frankly, the capital to execute the North American fix. That fix involves the complex supply chain relocation and that complete overhaul of their product creation strategy. Without that booming international cushion, honestly, market patience probably would have run out already. The crisis would likely be far, far deeper.
Which brings us right to the final investment question for you, the listener. The question that really defines the risk here.
Yeah.
It's whether that aggressive innovation race, that ambitious quantitative goal of hitting 35% new styles by spring 2026, can it successfully reignite the U.S. market? Can it pull the company through this storm before fierce competitors like Alo Yoga and Vuori permanently steal significant market share, and maybe before the patience of investors like Michael Burry finally runs out?
That is the multi-billion-dollar question, isn't it? And maybe here's a final provocative thought for you to consider, looking just beyond the immediate balance sheet pressures. Lululemon has historically placed a really significant emphasis on its major long-term purpose goals. Things like providing well-being access to 10 million people by 2025, achieving ambitious sustainability goals around materials and carbon neutrality.
Right, they talk about that a lot.
They do. But given the intense financial pressure cooker the company is in right now, this urgent near-term focus on just stabilizing margins and surviving this crisis, how does this short-term fight for profitability impact their commitment to those expensive, long-term, purpose-driven initiatives?
Will purpose become the next casualty in the fight for margins?
That's the question. It's a potential trade-off that will really test the true nature and commitment of this premium brand under extreme pressure.
That is a fascinating, complex trade-off indeed. Right, that wraps up this deep dive into the crisis of innovation versus the tariff shock at Lululemon.
Risk-defined, portfolio protected,